Hi, I'm John Huang, and today we'll talk about selling calls. But before we begin, quick disclaimer, I'm not a licensed professional, so I'm teaching theory in all my lessons. Therefore, any stock references will be only for educational teaching purposes only. Most importantly, please portfolio size and do your own due diligence. Thank you. Now, previously we talked about buying calls, where you have the right to buy shares. Now, today we'll talk about the other side of that coin. We talk about selling calls, which in a nutshell means you are selling away to someone else the right to buy shares. Right? So if you imagine I buy a call, so I can buy the shares. If I sold it to someone else, right, to another party, that party has the right to buy shares and they will be buying it from me, right? I have sold them the right to buy my shares. Okay, so this is how it works. Now, the important thing you need to understand is that in order to sell the right to buy your shares, you need to have the shares in the first place, right? This is one very big pitfall that a lot of newbie investors or option traders fall into, right? They are selling the right to buy their shares, but they don't own the shares in the first place. Now, this is a big red flag because at any time, your buyer may decide to purchase the shares, and if you don't have the shares on hand, right, you'll be forced to purchase from the market and sell it to your buyer at the price indicated in the strike. Okay, and I'll show you a little bit about what that all means when we do the demo. So here I am at my demo screen. And straight away, we see that the S&P has reached the previous all-time high and it's reached there and is struggling to stay afloat. Now, the first things first you will want to have is some shares. So previously, I've already purchased 100 shares, and this is the most important thing you guys need to remember when you are doing selling of calls, because you need to have the shares in order to sell your right to sell your shares, right? Can you imagine if you wanted to sell your shares and someone wanted to buy your shares, but you didn't have any? Then you'll be in very deep trouble. So I bought them at 408 and currently it's 423. So let's take a look at what we can do with this and what we are looking out for when we want to do some selling of calls. So first things first, we look at the chart and we see that, the S&P has reached a new all-time high, right? And just for simplicity's sake, I'm gonna say it's gonna drop. It will likely drop because it has hit a resistance or a supply zone, right? So I'm going to hedge my position and do a sell call, right? I bought it at 408. Let's just mark it out here. 408. And let's just say I want to sell it at a profit, or I'm looking for a profit of about, we're currently about 3%. Let's be safe. Let's just say 5% profit, right? Let's just say a 5% profit. So that'll be about 430, right? So let's take a look at the option chain and see what we got. First things first, we typically choose a time frame like our buy call. Right? Typically, a short-term time frame is good enough for selling positions, right? For a long-term, for buying of calls, you want the longer term because you want the stock to accumulate, right? Whereas when you are doing sell call, there is a strategy called selling covered calls where you collect monthly premium, right? And in order to collect monthly premium, your option just needs to expire every month, right? So a 1 month time frame is good enough for what we're gonna do for today, right? So I'm going to pick 430 and it's going to offer me about 227 premium for a 430 strike, right? So what does that mean? Someone is offering me 227 to buy my shares at 430. So I cannot sell my shares away to anyone else until beyond the 16th of July, right? So he basically paid me to reserve my shares at 430 all the way until 16. So if he doesn't come to collect, I keep the 227 premium. So that's how it works. So we're going to press confirm and send, and we'll take a look at the details before we finalize the contract. So maximum profit at 226, that is the premium that he's giving to me. And the maximum loss is infinite. Why is it infinite? And this is where a lot of newbies make that very fatal mistake. That's where most people destroy their whole accounts. It's infinite because the shares can go as high as it wants, but you must sell the share at $430 because it's in the contract. Somebody has paid you to buy your shares at 430. Now, imagine if you did not have the shares and the stock market has grown to become 630, right? Imagine it has gone up to 630 and you don't have the shares and the person has come to collect on you. Now, he already gave you 226 and now he says, I'm going to buy your shares for 430 and you don't have any. He's going to make you buy from the market at 630 and sell it to him at 430, right? So the loss is $200 times 100 because he makes you buy 100 at a time. So that's why they don't write the maximum loss. Because if the share price goes to $1,000, you're going to buy at 1,000 and sell at 430 because you already confirmed with the guy that you're going to sell at 430, right? There's no backing out or any of that. So that's why you must have the shares at a price below 430. In my example, I bought it at $408, right? So I'm okay to sell at 430. It's a profit for me because I already have it and I'm willing to sell it at a price. But if you don't have it and the stock market goes crazy, right, then you're in very big trouble. So you always need the shares, okay? So let's continue with this. I'll press send and let's see what it looks like. We've got our shares and we've got one, a -1 of a call, right? It's a negative call. So it's basically a selling position, right? We can tell straight away. And then our buying price for the shares is 408. And we receive on top of that 227 premium, right? It's in our pocket already. We received it. But the thing is that if the share price exceeds 430, our buyer will want to buy from us the shares rather than buy from the market. If the stock market went up to $600, it's more sensible for him that he already paid me $227 to buy my shares at 430 rather than 600 market price. So I don't mind because I already bought the shares at 408, so it doesn't matter. It's profit for me either way. Right? But for others who do not have the shares, they have to buy it at 600 and sell it at 430, and that's a massive loss to them. So let's go to the future and see what happens. 16 July is our expiry date. So let's go to 19th of July. And just like that, right? Look at it. My stock price of 430, right? It reached 431, in fact, right? On this date. So because it has, and this is a bit more technical, typically if the market closes above, the buyer is usually inclined to purchase your shares, right? But for this instance, for a $1 profit, he's paid me $227. To earn a profit of just $1 is not enough for him. So he chose not to exercise me, right? I still hold my shares and I keep the premium. 227, right? And he has gone away. He cannot exercise me anymore. So just like that, just by holding my position, just by offering to sell my shares at whatever price, they don't care whether I'm profitable or not. But for me, I know I'm profitable because I chose the strike of 430. Then just by doing that, I collect $200. And I can do that again for the next month and the next month and so on and so forth, as long as I retain my 100 shares. And I don't need to do anything. We simply let the contract expire because the money, we already collected it. And we are comfortable with selling the stocks at whatever price we chose because we chose it in the first place, right? So that means that you need to have a little detachment from the shares that you have collected over the years. There needs to be a price that you're willing to let it go at. And if you stick to it, you can get rewarded, right? You are being paid premiums in exchange of selling your shares at a price that you decide, right? So it's really fair for all parties involved, right? Someone is willing to buy from you at whatever strike, and you are willing to sell to them at whatever strike, right? You get to decide. So this is selling calls in a nutshell. Basically, you need to have 100 shares in the first place, and you are selling the rights for someone else to purchase it at a price that you decide. So if you pick something that you find reasonable, right, that you don't mind selling it at, right, and then you can collect premiums, right? And of course, once the contract expires, you can do it again at perhaps a higher price if the stock market has gone up, right? But you hardly ever want to choose a strike lower than what you paid for, simply because you are confirmed going to sell it at a loss if the stock retraces, right? So typically we don't want to sell a call lower than what we purchase our shares for, always higher, right? That's just a simple way to remember it, right? You must have the shares, and then you pick how high you want to sell it at, right? And then you collect premium if nobody exercises your contract, right? So if nobody exercises you, then you can sell again and again and again, and that's how people actually generate monthly premiums from holding shares, right? So it's very good for when you already have 100 shares and they're just sitting around doing nothing. And then you can decide that you want to sell them off at a profit, and then you harvest the premiums monthly until someone takes the bait, right? So that's generally how it works. So if you found this video useful, right, or you know someone who may find this interesting, please share this with them. Please like this video and please subscribe to my channel. And I've got a community as well that you can choose to follow, right? So if you know, doesn't take much for you to like this video, it's greatly appreciated, and I'll see you guys in the next video. Bye.